Hey everybody, welcome to part two of my investment performance of 2025. In the first part of the series, I walked through my 2025 performance, what the portfolio did, and how it ended in the year. As you remember, the weighted average of the performance was very good. It was 50% rate of return. On the year, I have four portfolios. One portfolio did 90% return, and the weakest portfolio did 42%. But I'm very happy with those. But the combined return was 50% for the year. In this video, I want to talk about what actually matters probably more. People are more interested in performance, but this is probably the most important part. What I learned and what I'm going to do differently moving forward. The past is the past, the future is what we don't know. So this is what's going to be setting me up for hopefully success in early retirement. So those lessons are going to shape my investing strategy for 2026 as I move into early retirement. This part is less about percentages and more about decision making, more about managing risk and how the risk for me has changed. And my risk level is going to be changing. It's going to be reducing because I'm into early retirement earlier than I expected. So this will also involve how my mindset evolved and what I'm focusing on that will protect my capital and income, which matters more than chasing growth. I'm still after growth, but not to the extent that I was last year. So if you're interested, stick around. Here's part two of my investment performance. Some of the lessons I learned this year, I certainly didn't make up these words, but they were lessons that I learned and they really stuck to me in 2025. So FOMO is the first one. So that's the fear of missing out. So I started the year with a fairly large amount of money that I was going to invest in and DCA, basically dollar cost average throughout the year. But in the beginning of the year, the market was roaring right after Trump got into the office. Planned to slowly invest this money in throughout the year and then wait for dips. But the market was really going crazy, and I went a little aggressive too fast. I got FOMO. I saw these stock prices going up, and I'm like, I'm missing out, and I didn't want to miss out. So I went a little heavier too fast at the beginning. In the first 3 months, Trump tariffs crashed the market in April. And I had less money than I could have had if I just stuck to my plan. Make a plan and stick to it. That's the other part of this lesson. The extra money I could have had if I didn't have the FOMO, I would have a return at least 10% better than what I have now. But anyway, I'm trying not to be greedy, but it was a hard lesson to take. But fortunately, the money that I still had, I was able to invest in very aggressively because people run when there's blood in the streets. And when there's blood in the market, people run. So the tariffs came and I'm like, I took a majority of the money that I still had remaining and I dumped it into stocks that I've been waiting to buy when this crash came. So I wasn't afraid when the market did crash. So for the second lesson I learned was the fear of losing everything. FOOL, FOLE, and this was the second lesson: the crashes and the scare. So I realized how much I learned not by being scared out of the market from the past few years. I stayed cool and level-headed during the volatility, and in April in particular. Huge drop. You can look out on the chart. But my biggest stock regret with that related to this was selling Nvidia for a small gain right before the epic rise to where it is now. So back in 2022, I started buying Nvidia, NVDA, and this investment alone could have been a huge game changer on my portfolio, and it still hurts to talk about now. So I had a decent amount of money into it, relative to the size of my portfolio, and I was listening to news and some other YouTubers who were trashing Nvidia, and I got scared and I took like a 2 or 3% gain on it. I was at the bottom. I was buying at the bottom of the chart, and it was right before the meteoric rise to where it is now. I think it's over 3,000% gains. It might even be more than that, but it hurts to talk about it even now. So stupid. I was listening to people I shouldn't have been listening to. They didn't know what they were talking about. Third lesson I learned was I didn't chase high flyers. I was better at not chasing, watching stocks soar, because what goes up must come down. And usually they always come back to their 200-day moving average. Anyway, I won't go into the details about that. I don't know what I'm talking about. But anyway, I just started understanding more the technical side of the technical analysis. And I just realized, most stocks return to their averages. And when something starts going parabolic, I don't chase it anymore. So I'm better about that. Number 4, I cut losses and sunk costs on stocks that I lost conviction in. There weren't many of those. Similarly, I stopped throwing good money after bad money. This was a difficult one, but because no one wants to lose money or admit they made a mistake. However, repositioning the money I sold often made up for any of the losses I took. Yeah, there was 1 or 2 that I sold at the end of the year. It was tax loss harvesting, and then just a couple stocks I didn't care for anymore. They were just a small position. I just took my loss and I stopped throwing money at it to try and lower my cost basis. That's a big mistake. I knew how much money I wanted to invest in, and once that I reached that limit, I stopped. Number 5, I used stop losses for the more speculative investments. Again, cutting a loser and moving on. One of the groups I belong to, they give out some potential trades. Again, it's not day trading, it's more swing trading. It's watching the technical analysis. And so basically there, $1,000 invested, the most you can lose is $1,000 unless you have a stop loss. Maybe you might lose $700 or $400 of that. But the potential is huge. It's endless. The sky's the limit. So the examples are Palantir, Rocket Lab, HIMS, and Saido. Number 6, I'm less afraid to trim, even when stocks are at all-time highs. While people are chasing having the FOMO, I'll just start selling a few shares here and there to lock in profits, or sometimes cut the position if I feel like there's no more room to run on this one, and start building a cash position with those gains and those sells, and just wait for other opportunities. So that's how I did very well in my Roth for the past 2 years. I trimmed and more. The thing is, I need to trim more slowly. So number 7, the blueprint that I created, that was a lesson learned. I knew what kind of stocks I wanted, and in proportion. When I started investing in 2020, I had no idea what I was doing. I thought buying a couple stocks was a stock portfolio. It wasn't. Just buying. It made no sense. So I built a structure, I built a plan, a blueprint. You build a blueprint when you have a blueprint when you build a house, because you want to know what it looks like when you're done. And I knew what stocks I wanted to sit in there. So that's why I have my structure for my 8 out of 10 risk level is I wanted 25% ETFs, 40% growth, 10% speculative, and 25% dividend payers. The 8th lesson was I went too fast to house shares with some of my stocks. When they doubled, like there was a couple that I quickly sold 50% to get my money back, but then those stocks continued to go parabolic, and so I lost 5 and 10xers out of that. But I made money. I can't complain. It's just it depends on the stock that I'll do that with. If some of them I think will double and I don't really care to hold it anymore, I'll just cut it and take the gains and move on. So number 9 was don't go it alone. So I paid to belong to 2 investment groups. One group, we come up with ideas and we share ideas, and it's more learning to fish, teaching someone how to fish rather than be a fisherman. and I've made a lot of money from that group. And the other one is I paid a paid service to actually do the due diligence on stocks for me. So I don't listen to them blindly. I do read their reports and their recommendations. There's some stocks they recommend that I purchased, a couple that I didn't purchase because it didn't fit my blueprint. It's not something I wanted to invest in. But I made enough from both of these groups to pay for their annual fees for 10 years. So it's definitely worth the investment. And then one other thing I learned that's kind of more of on the budgeting side is, and I had an emergency fund. Going into 2024, I reluctantly made an emergency fund of about $7,500. It was really hard to do because the market was doing well and I didn't know I was going to be retiring. The emergency fund saved my butt in 2025, let me tell you, because when I knew I was losing my job, we decided we were going to get married and have a ceremony before I left. The wedding ended up costing much more than I anticipated, and I didn't have the money to pay for those things, at least in my monthly income. I couldn't cover those costs. I was able to cover those costs with the emergency fund. So I didn't need to go and dig into my investments, thank God. It really saved my tail, and I'm grateful that I did that. Otherwise, I would have been taking out of my investments and drawing down on my stock portfolio performance. So it was a bit of a lifesaver there. So this is my objectives for 2026. One, I'm paying for financial advice. So a comprehensive financial plan from a financial advisor. This is going to cost me $3,000. I don't want to go with this alone. You know, it's a small percentage of my portfolio, so it's critical that that since I've not done this, I did do a superficial review of my portfolio last year at the beginning of the year when I didn't know I would be losing my job. But I'm using the same group to develop a more specific, comprehensive plan for me because I don't know what I'm doing. I'm not sure I'm not confident about what I'm doing, and I need some advice, especially around taxes and how to manage my portfolio so that we can live off of it now. I also paid for a Boldin advisor. I use a software called Boldin, Boldin. It's an investment, it's a retirement software and I paid for an advisor to look at it. It's a little complicated, and I'll do a separate video on that, but it was worth the money. It was $250 for him to go over and spot the problems that he saw with the numbers that I put into the software. Number 3, I'm building on my bucket one with 2 to 3 years of living expenses. I'm doing this slowly because I do expect 2026 to be another year, a good year. I don't want to lose the extra gains because I'm moving into cash. So I'm going to do it slowly and carefully, and watch me. I'll include this in my performance for the year. So number 4, I'm going to monitor my spending against my budget. I'm going to track it in Quicken and Excel, and I'd like to do it. I'm a nerd. I've been doing this my entire life, and now I'm going to share it with the world. Number 5, I'm engaging my wife more to more clearly report in detail what she spends money on. She's been doing this for years, but we're just going to get a little more specific and have her more engaged on the process. She won't get in the investment side. She doesn't understand any of it. Number 6, I'm not going to take more risk with my core investments. I'm going to start de-risking. Number 7, if I can get some odd jobs to supplement my expenses, I'll do that. If YouTube makes money, that's wonderful. I'm not expecting it though. Number 8, after the initial cost of my house improvements and the car, we plan to live on my investments very frugally. We're going to enjoy life. We're going to eat well. We just will not be spending gifts and things like that. I already made it clear with my wife. And number 9, I'm going to avoid touching my investments at all costs in 2027. So my projections for 2026, take this with a grain of salt. I have no idea what I'm talking about, but I do listen to people who do. And most of the known analysts are bullish and calling for another double digit gain in the year. From what I'm seeing with the devaluation of the US dollar, the dropping of interest rates, spending of AI, I believe my portfolio should still do well, and I'll be ecstatic if we get at least another 15%. At least if I get 15% on my portfolio this year, I'll be ecstatic. If I get the average 10%, 11%, I'm okay with that, but I don't expect that. Well, if I was just going to get the average S&P 500, I would just invest my money in the S&P 500. I wouldn't even bother with it, this stock portfolio. I wouldn't even bother with all these stocks. I have about 42 positions in my brokerage account, and I plan to reduce that down to around 25 or 30. But if I wanted the stock market average, I would invest in the S&P 500. I wouldn't even bother with this. So I'm expecting at least 15%. I do think it will be better than that, but 15%, I'll be ecstatic. So unfortunately, I have to de-risk, but I'm going to de-risk slowly. It might be a mistake. I don't want to go into that frequency of risk returns early in retirement because that could hurt me, but stay tuned to see what happens. Well, I'll do it quarterly, but we'll see at the end of the year based on my projections. So just recall that the top analysts, contrary to that, the top analysts were calling for 2023 to be another bad year, but 2023 ended up being the beginning of what was an extraordinary year of returns, and it has been for the past 2 years. So analysts are wrong. If they're wrong, what am I going to do? The point is, don't invest based on predictions. Buy good companies at good prices, and in the long run, you should do well. My biggest unplanned expenses going into 2026 were wedding costs, costing me around $12,000. House repairs and upgrades to the house at the end of the year were $5,000. Health insurance, I've got to start paying for my own inpatient house insurance at $5,200. We bought a car, much more car than I expected to. It's almost double than what I was planning. My average expenses for 2025 were just under $7,000 a month. That's what my next video is about. And then I will do a separate video on my budget for 2026. And why I hope to cut the last year's spending by more than half is by simply living simply and now. So remember, you do you, I do me. This video was just the investment side of the picture. I plan to do quarterly updates with my progress of my plans and my performance, so stay tuned. Thank you everybody for joining me. I really appreciate you being here. Give me a like, subscribe, and take care. God bless and take it slow.